And also, our strategy is probably one of the only strategies that we're aware of that benefits from higher tax rates. So in some ways, we're effectively a call option for an increase in tax rates. And really, when you bring up music royalties, that's a great parallel. We don't think we're all that different from the pharma or music royalty space. Unfortunately, what we do isn't ever going to be as sexy as buying, say, Taylor Swift or Justin Bieber's music catalogs. But still, pharma, music royalties, they're both relatively new asset classes that bear a lot of similarities to TRAs. They're long dated, annuity like cash flow streams that are generally uncorrelated to broader market performance.
Hello and welcome to Signals by AlphaSense, where we hear thoughtful insights from business leaders, investors, and experts.
Hello and welcome. You listen to Signals by AlphaSense, and I'm your host, Nick Mazing. Today, we're going to talk about Tax Receivable Agreements, or TRAs for short, as an emerging asset class. TRAs are transferable corporate tax assets that historically have had little secondary market liquidity. They fall in the category of esoteric asset classes like art, like music royalties, like wine. But what's interesting is that often what is an esoteric asset class today becomes mainstream over time. The prime example being securitizations. At one time, securitization had been novel. And now not only do you have mortgage securitizations, but you have other securitizations like cell phone tower rents, like aircraft engine lease payments, like franchise fees. If Domino's Pizzas does those, and the filings are actually public on Edgar. Today's guest, Saish Setty, is the general counsel at Parallaxes Capital, an alternative asset manager investing in TRAs. Saish, welcome, and can you tell us a little bit more about you and about your fund?
Thanks, Nick. So to take a step back, let's think about tax generally. This is probably the largest asset class in the world that no one has ever really heard of or thought of as an asset class. Even in the fabric of our daily lives, two things are unavoidable: death and taxes. And obviously, at our lives at Parallaxes, probably tax receivable agreements as well. So tax receivable agreements, TRAs, they're a subsegment of this larger opportunity set, and we view them as the tip of the spear to unlocking the rest of the universe in this asset class. For TRAs themselves, we estimate that almost 10% of domestic IPOs in recent years have included a TRA. So for example, in the last few years, TRAs were included in the IPOs of TPG, Chips, and Rocket Mortgage. And now a little bit about ourselves at Parallaxes. Parallaxes Capital is an investment manager entirely focused on TRAs. And our portfolio includes names like Planet Fitness, Funko, Shake Shack, and Remax. So a lot of household names that we're dealing with. And we were founded in 2017. And since that time, we've deployed over $250 million to the opportunity. As for myself, I joined the team after stints at Wachtell and Paul White, and I also act as the firm's general counsel. And really, what we offer our LPs the opportunity to invest in an uncorrelated and cash-yielding asset class that's a greenfield opportunity. We don't think there's anyone else doing what we're doing. And also, our strategy is probably one of the only strategies that we're aware of that benefits from higher tax rates. So in some ways, we're effectively a call option for an increase in tax rates. And really, when you bring up music royalties, that's a great parallel. We don't think we're all that different from the pharma or music royalty space. Unfortunately, what we do isn't ever going to be as sexy as buying, say, Taylor Swift or Justin Bieber's music catalogs. But still, pharma, music royalties, they're both relatively new asset classes that bear a lot of similarities to TRAs. They're long dated, annuity like cash flow streams that are generally uncorrelated to broader market performance. And we expect and hope that the TRA industry will follow the explosive path that we've seen take over those royalty spaces in the past few years.
So let's start with the basics. What are TRAs? And to be clear, when people talk about tax assets, most tend to think about net operating losses or NOLs. And TRAs are not NOLs. They don't have like the anti-trafficking restrictions in the Internal Revenue Code. And they're really corporate obligations, so to speak, closer to bonds. So what are TRAs? How do they arise?
Sure. So at its core, a TRA is just a contract. It's a contract where one party agrees to pay out the benefits it realizes from tax assets, like a depreciation deduction or an NOL, to a third party as and when they realize those economic benefits. So because of this structure, they are debt-like instruments. And more importantly, the underlying tax assets themselves aren't being transferred here. So like you mentioned, the anti-tax loss trafficking rules, they're just not implicated in this context. And TRAs themselves, they can be broadly applied to many contexts, really anything where there's an underlying tax benefit. So for example, let's take a private M&A transaction. If the buyer and seller disagree on the value of a target's tax assets, they can actually use a TRA. And the TRA here would allow the seller to keep the economic benefits of those tax assets. The seller can then hold on to the TRA assets or sell it to a third party like ourselves that they believe more appropriately values the assets. Now, one of the most common situations where you have a TRA is in an IPO. And for a little bit of background, when companies go public, they generally need to be structured as a C Corp. Now you have exceptions like REITs or MLPs, but let's put that to the side for now. So if you have a company that's a partnership or an LLC, it can still go public, but it'll probably structure its IPO in what's called an Up-C structure. One of the first Ups was actually for barnesandnoble.com in 1999. You probably guessed the year from the .com appendage there. And since then, the structure has become more common. So recent Up-Cs include names like TPG, Dutch Brothers, Bumble. So this is hardly an industry-specific type of structure. Now, the Up-C IPO, the structure itself basically generates tax benefits for the public company. These tax benefits are then shared with the company's pre-IPO owners through the TRA. And again, in terms of history, the first TRA was in the early 1990s, and they've gradually become more and more common. Again, we estimate that almost 10% of domestic IPOs in some recent years have included a TRA. And to put a little bit of context around those numbers, in the 2021 IPO boom, there were over 75 TRAs created. And that's in comparison to only about 15 in 2015. And even in 2022, where you had very muted IPO SPAC activity, there were still about 20 new TRAs created. And so over the last 5 years, we believe the TRA market has grown to encompass now more than $30 billion of expected payment. So the growth in the space has just been truly exciting.
So these are obviously very interesting assets, but why is the TRA structure in place to begin with?
Yeah, so that's a great question and one that we often get. Academic theory suggests that TRAs do not negatively impact a company's equity valuation when it IPOs. And TRAs are extensively disclosed in a company's public filing, so it's not as though they're hidden from view. Looking back at my example, the TPG IPO, for example, when you look at their S1, they mention their TRA over 100 times, including in a number of risk factors. So then I think the natural question is, well, why doesn't a TRA impact the company's valuation? It is cash that they're paying out to a third party. And there are a few theories there. One is just that they are difficult to value. The valuation difficulty stems from the fact that you need to estimate a company's future taxable income. You have to have a deep understanding of the relevant tax assets. And at Parallaxes, maybe this is a dynamic or an explanation that we're a little partial to, since it helps us build our competitive moat. But another common justification is that public market investors are just simply more focused on metrics that don't incorporate tax. So if you're valuing a company based on EBITDA or a revenue multiple, then whether or not the company keeps these tax assets to themselves is basically irrelevant. And really, the other day, I picked up one of those old investment banking guides I had on hand. And before I get criticized, forgive me, I'm still a lawyer by trade. I need to refer to those things every now and then. But when you look at the DCF section, they have about 60 pages there. And of those pages, there were about 4 or 5 sentences on how to back out the impact of tax into the cash flows. So in an IPO, it's just not surprising that these tax assets are disregarded or overly simplified in the valuation process. So at its core, pre-IPO owners are incentivized to include a TRA in their structure because public market investors just don't compensate them for the value of these assets in an IPO.
So, we discussed how they arise in different situations, and, it's an obligation between the corporation and its PE owners looking to exit, former PE owners, whatever you want to call them. Now, you acquire the TRAs from these PE funds. Why would a PE fund actually look to exit the TRA?
So for a PE sponsor or really any fund, you can find yourself near the end of a fund's life and you're still holding on to these TRA assets. In that situation, you're almost a forced seller. And for others, the TRA asset, it just might be too small to be a focus. It's an asset that they don't understand. It's also something that pays out over a long duration. So people just don't want to, or in some cases aren't able to hold it to maturity. And this is funny, but in some cases, it may not even be something that the holder knows they have. It's hard for me to personally imagine this, but it's not just theoretical. A few weeks ago, we were actually sourcing a potential investment and speaking to a massive VC shop. It's one that we've all heard of. And we were prepared for the conversation. We had our decks ready, our models ready. Now, what we weren't prepared for, Nick, was them claiming that they didn't even own a TRA. We had to pull up the Edgar filing off the SEC website and point out where they actually signed the TRA. And this is an asset that was valued in the tens of millions of dollars. So in some ways, you'll always find holders that are thrilled to find value that they just didn't know existed. And to them, it's almost found money.
And there is another angle that when we were talking before the recording, and that is an ESG angle, which I thought was interesting. So how do you think about it in through kind of an ESG lenses?
Yeah, so this is actually something we've been spending a lot of time on as an institution. And let's face it, tax-related strategies can inherently just be a dirty word. But really, tax is one of the most powerful incentives that a government has to incentivize good behavior, to disincent bad behavior. And similarly, it's a powerful tool to affect ESG goals. And we believe that TRAs themselves further these goals. So much of ESG is focused on the E, let's be honest, less so on the S and G. But the S and G, that's where TRAs really shine. So, for example, on the social aspect, there's been a lot of thought and a lot of discourse on how companies should support tax policies that support long-term value creation versus just a tax minimization. But really, how realistic of a goal is that when almost every stakeholder in a company benefits from lower corporate tax rate? Equity holders benefit, employees, management, debt holders, arguably everybody benefits from a company having increased cash flows because it has a lower corporate tax rate. But TRA holders are a little different. We actually benefit from a higher tax rate. And that's because our expected payments, the expected benefits under the TRA increase if you have a higher tax rate. So with the TRA in place, at least there's one stakeholder with a competing interest here. And again, on the social front, one metric to determine a company's social contributions is frankly its total tax contributions. But this is extremely difficult, if not impossible, to glean from a company's public disclosures. That needs transparency, and honestly, that transparency is provided to TRA holders. Holders often receive a company's tax returns themselves, or at the very least, they're receiving detailed information on how the company is calculating its taxes. And then on the governance front, on the G, TRAs promote better reporting and communication with stakeholders. You also need better process controls to ensure compliance with your TRA obligations. And TRAs themselves, they're also a really useful part of a compensation package to management members. You have payments here that are actually tied to a very concrete metric. They're tied to taxable income. And they're isolated from the market euphoria that can really distort something like stock-based compensation. But similar to stock-based compensation, TRAs pay out over a long time period, and that alone can help eliminate some of the tendencies to short-termism. And again, TRAs, they aren't designed to have these benefits. This is just part of their very nature. And if anything, that's why we believe they're very powerful tools of the ESG framework.
On your end, obviously you're investors, you're on your fourth fund now. How do you analyze these at the individual and at the portfolio level? They're obviously interesting as an asset class, but what really goes on in the kitchen?
So maybe I'll oversimplify it a bit with this statement, but at its core, what we're doing is we are offering existing TRAs a factoring solution. They hold a long dated asset that pays out over time. We take an NPV of that and we come to a view on price. That said, the devil is always in the details. We have three main considerations when valuing a TRA. First is that we have to understand the tax collateral itself. So by that, I mean the underlying tax deductions or tax assets subject to the TRA. The second is that you have to come to a forecast of taxable income. And then the third point is, well, once you have those two items, you still need to construct a discount rate. So on the first part, the tax collateral, here you need a very deep understanding of the tax benefits or assets that are subject to the TRA. This requires tremendous knowledge of the tax code. Our CIO actually has a master's in tax, and that is certainly a massive help on that front. And really, that's a pretty unique combination that you very rarely see amongst deal professionals. I think most deal professionals, when they hear the word tax, they kind of want to take off in the other direction. And that is absolutely not something that we can do. But again, the second point though is forecasting taxable income. So once you have an understanding of the tax benefits, you have an understanding and a forecast of taxable income, you overlay those two items and you come to a stream of assumed cash flows under the TRA. Once you have that, then you come to the last step. That's constructing a discount rate, which is always a bit more art than science. And in our view, we're aggregating perceived risks from credit risk, from a duration risk perspective. And by duration risk, this is really the idea that payments under the TRA may be stretched out over a longer period than we expect them to be. And so that's a risk that we incorporate into our discount rate. And we also include things like illiquidity risk, since we expect to hold these items to maturity. And then finally, even legislative risk, that's factored in since, as we mentioned, tax rate changes will impact our payments. So putting all that together, we're able to figure out a price that we're willing to pay for any given TRA asset.
So, what would you say is your edge here? What gives you an advantage in this marketplace?
Yeah, I mean, at this point in time, I think our strategy benefits from a number of market inefficiencies. One framework for how to think about this that I find useful, at least, was put out by Blue Mountain a few years ago. This is the BATE framework. So you're looking for B, behavioral, A, analytical, I, informational, and T, technical inefficiencies. On the behavioral front, really investors typically have a tendency to move as a flock. Parallaxes has a first mover advantage here. We're operating in a complex asset class that has many modes to entry, and there really just aren't any other dedicated players in the space right now. On the analytical side of things, we have an edge from operating on a very different time frame, and we also weigh information differently. So we have a very different view on duration, as we expect to be able to hold these assets for a long time, and we structure ourselves in a manner that allows us to do so. And we're also able to weigh information differently, since tax disclosures and public filings can be meaningless to a lot of analysts without deep tax knowledge. And similarly, on the informational side, we again have an edge due to our domain expertise. We're focused on information that might just be noise to other parties. As we mentioned, tax assets, the related information, they arguably don't even affect equity valuations. So in a lot of cases, we might just be looking where others aren't looking at all. And then finally, you have technical inefficiencies. These are where market participants have to say, buy or sell assets for reasons that are completely unrelated to fundamental concerns. And again, this is a dynamic that we can take advantage of at Parallaxes. As we touched on before, we frequently encounter counterparties that are selling due to something like an end of life consideration, end of fund life consideration. Meanwhile, the transaction size, that just might not be practical for a lot of participants. And other market participants, they might just not even have the mandate or the expertise to engage with these types of assets. So when you take all of those factors together, I think we're building ourselves a pretty difficult moat for other people.
So let's dig in the details a little deeper. So everyone who has ever read bond covenants knows that they can be very unstandardized. It's absolute nightmare in some cases, especially in distress situations. You have a great white paper that our listeners or viewers can request from your website that details a lot of technical aspects that are involved. I read the white paper with great interest.
Much
And
appreciated.
this and these are things like minority holders, like obligations of the corporation itself, since that's essentially an external transaction and so on. So can you give us some of the highlights on these topics?
Yeah. I mean, TRAs, they are a newer instrument. So when you look back 10 years, you often find TRAs that aren't well drafted. They're sloppier. They don't include the provisions you see in a newer TRA. That said, we have seen TRAs become a bit more standardized in recent years. And this is a process that we hope to continue to drive with our white papers. Because even though they become more standardized, they're still not at the level of a bond indenture or credit agreement. And in terms of specific provisions, unsurprisingly, one of the biggest points we care about is transferability. So again, one of the most common assignment formulation makes it so that TRAs are freely transferable. That's basically what we want to see. That's about 1 out of every 3 TRAs. The rest can really, really vary. In some, you need company consent, and this can take many forms, and it can also really be a massive roadblock to a transaction. And to make it more concrete, a few months ago, we were working with a firm on a TRA sale. We had fully negotiated the documentation, agreed on price, the works. The last step, naturally, was just obtaining company consent to the transaction. That a lot of us took as something for granted here. Lo and behold, the company refused consent. And really, that's just a terrible outcome. Sure, you can have a blacklist and a credit agreement, but in the debt world, flat consent rates like that are more or less unheard of. And these are the types of things that we hope to move the market on. And TRAs, they're drafted by the best law firms in the world for the most part, but they're often not drafted with transfers in mind. And that's something in particular that we want to change. And there are other provisions too that impede transferability or disadvantage holders. So, for example, in the bond and loan market, you'll often see strong protections against adverse amendments. And even with that, there's still been an onslaught of lender on lender violence that you alluded to with coercive exchanges and the like. But even in that context, bonds, loans, they will have sacred rights, things that are untouchable. You can't just go out and amend down the principal in a bond without getting everybody's consent. And these are the types of protections that we want to see more explicitly built into TRAs. And again, these aren't just selfish considerations. Realize the focus on assignments might sound a little selfish, but we want TRAs to flourish in the market. And one item of focus for companies is potentially the operational burden of a TRA. So sometimes tax benefits under the TRA, they're going to be created when you have equity holders that exchange subsidiary units for corporate stock. And the frequency of these exchanges can create a ton of administrative burden for companies. So that, for example, is something that they might want to limit. And there was one asset manager in particular that had an earlier TRA, and they had a ton of partners that were party to the TRA. And these partners, they're all sophisticated. They're exchanging units on a daily, weekly cadence, everybody doing it at a different time. This is just a huge burden on the company. Each exchange can create a new work stream. And limiting things like that, limiting that flexibility, all of those can help reduce the operational hassle for a company and hopefully incentivize more TRAs in the market.
Another thing that was interesting in your white paper is how many household names, so to speak, famous companies are involved in TRAs, and in some cases, TRAs are a factor in special situations like takeover proposals, in some cases around distress. So, can you share with us some of those situations and what's going on there?
Yes, it's definitely. In one situation in particular, there was a mattress company with a TRA. And for a little bit of background, usually when a company that's issued a TRA is acquired, you would accelerate all the obligations under the TRA and it's paid out to holders. So it's effectively a make whole. Now, when this mattress company received a takeover proposal, this was in the fall of 22, it was actually conditioned on the company just waiving or obtaining a waiver of these change of control acceleration provisions. And Ultimately, this proposal was rejected. The acquirer launched a campaign to nominate board members. The company, old playbook, put a poison pill in place. And this was actually all resolved earlier in April. The poison pill was removed. The company made concessions on its board nominees. But it was super interesting to see the TRA actually be a central part of the acquisition negotiations here. And another recent acquisition, this one was with a financial advisory firm, and the acquirer was a sponsor, private equity sponsor. They actually structured the deal to provide TRA holders with a promissory note instead of an accelerated payout. So again, TRAs, they're generally newer instruments. So I at least find fascinating, maybe that paints me as a bit of a dork, but I find it fascinating to see how they're playing out in the acquisition context. And then on the distress side as well, one situation that we're focused closely on is a car retailer. They're in a distress situation, and under the company's TRA, a bankruptcy, like a change of control, results in an acceleration of the entire TRA. And the company here is actually controlled by a single family, and their TRA holding will actually provide them with another avenue to influence a bankruptcy proceeding if and when the company files. And I find at least a lot of commentary here. People are so focused on the family's equity stake, but it's the TRA that actually provides them a more senior means to influence the bankruptcy proceeding. And we'll see what happens here. But again, it's extremely exciting to be on the forefront of a new market and to watch it develop in all of these different contexts.
Saish, thank you for joining us today.
Great. Thank you, Nick. It was always a pleasure.
This was a great overview of TRAs as an emerging asset class with Saish Setty of Parallaxes Capital. We learned about how TRAs actually arise, how to think of them as an investable asset class, and what his fund actually does. We'll have all the relevant links in the show notes. This was another episode of Signals by AlphaSense. My name is Nick Mazing, and you can find us on all the major platforms. Thank you for watching or listening.
Thank you for joining us. This was another episode of Signals by AlphaSense. Keep in mind that all views presented here are the views of the guests and hosts and do not represent the views of their employers or of AlphaSense. Nothing in this podcast constitutes investing, tax, legal, or medical advice. If you enjoyed this episode, leave us a rating and review, and subscribe for more.